Rate cuts are not a magic bullet. And I'm going to refer to Mike Tyson, who basically eloquently put, everybody has a plan until they're punched in the face. The economy is going to be punched in the face late next year, this time next year. Somebody please tell me where the four horsemen of deflationary pressures have gone away. In fact, some of them are much stronger.
Rallies across the board today on Thursday, September 19th. The S&P 500 is up 1.7%. The NASDAQ is up 2.7%. The Bitcoin price is up 6%. Even gold is up 0.5%. The 10-year yield is up 1.6%. The dollar is slightly down. Crude oil is up 2%. Markets are just euphoric about yesterday's Fed rate cuts, 50 basis points. However, if you take a look at history, and we'll talk about this today, the last time the Fed cut by 50 basis points, it was during a financial crisis, 2020, 2008, and 2001. So are we in a financial crisis today? Is that what's going on? Clearly, the markets don't think so, but what's really going on? Where are the markets headed next after yesterday's Fed rate cut? And by the way, the Bank of England also met today. They did not cut rates. Why not? What does this mean in regards to the global economies and central bank policy divergences around the world? Jim, welcome back to the show.
Good to see you, David.
Jim Thorne is the chief market strategist of Wellington-Altus Private Wealth. We've spoken several times with Jim this year. Links down below to our last interviews. Jim has called for the markets to rally more until perhaps 2025, when things could take a turn. Then we'll revisit that call, and we'll revisit why Jim may still be long. Markets are rallying today on the back of the first rate cut since 2020. Jim, let me take a look at my screen right now. The wonders of technology. I asked ChatGPT before our call, give me the last 5 times the Fed cut the Fed funds rate by 50 basis points. They were March 2020, October 2008, January 2008, April 2001, March 2001. Does that look like a pattern to you, Jim? Does that every single time they've done this in the past, in the last 5 times at least, it's been in the midst of some sort of crisis. So is that what we're seeing now?
No crisis, David. That's the difference this time. There's no crisis. The Fed is trying to land a soft landing. The Fed has a very difficult job in the sense that, and just to review for your listeners, my thesis has been that this economy looks like we're coming out of World War II. So think of the COVID economy being the World War II economy, and we go from a wartime economy to a peacetime economy. So David, this year in the United States, the fiscal deficit has increased by 25%, 1 year into a presidential election, right? So what we have on the one side over here is we have an economy that's been goosed by unsustainable fiscal spending. And then on the other side over here, we have a private sector that's going into recession. So my thesis had always been is let's just parse the two and let's make the call that fiscal policy growing at 25% is unsustainable, and it's going to decline next year. And when it does, we're going to have a growth scare. And over here on the other side, we have a private sector that's going into a recession, which if we had a normal time, right, where we didn't have fiscal policy run wild, the Fed playbook is that when the market is balanced or their mandate is balanced, price stability and the job market is fairly balanced, like they said yesterday, then the Fed funds rate has to be at neutral, or what we call R star, which is approximately 275. So the Fed is really trying to thread a needle here. The 275 comes from the New York Fed website. And so what I would suggest to you is we don't know what the growth scare, if it's going to be a hard landing or a soft landing, until late 2025 or 26. But what I will say to you is this, and it's about growth. David, I will take the under. After the election, I will explicitly state that there is no way that the fiscal deficit will grow at a 25% CAGR. And if it just grows at a 10% CAGR, we will have a dramatic slowdown. Where I differ from all the pundits is the fact that it's not the level of government spending that drives G for the gross domestic product. It's the growth rate. David, the growth rate of fiscal spending is going to dramatically slow after the presidential election. So the Fed, I think what the Fed is trying to do is they're trying to take a 747 and land it on a post-sip stand, which is they've got to get the private sector going. Remember, they got lags of 18 months before you have a dramatic slowdown in fiscal spending. And just two things for your listeners. One, 1920, the depression that everybody forgot about, right? It was what do we get? Coming out of World War I, wartime economy to a peacetime economy, and dealing with a pandemic. World War II, same thing. So I am not calling for a significant slowdown in government's in the level of government spending. All I have to do is call for a decline in G for me to get where I go.
Are you liking the video so far? Well, before we continue, let me tell you about an innovative way to create videos, which I can tell you from personal experience can be challenging and time-consuming. Today's sponsor, InVideo AI, makes the process incredibly simple. Whether you are a content creator, marketer, or business owner, InVideo AI transforms your ideas into polished, professional quality videos in just minutes. It's the world's most used AI video creator with over 10 million users across 150 plus countries. All you need to do is type out a text prompt. From there, you can get creative and fine-tuned ideas for your videos using just text commands. It's like having your own video editor on standby. And the best part, you can clone your voice and make it narrate the videos in your own voice in any language. It does the job of more than 10 tools packed into one and costs just $20 a month to start with. Scan the QR code on the screen here or use my code link down below to get 2 times the video generation credits in your first month. Okay, I want to come back to that statement a little bit later in the interview. Rate of growth of fiscal spending to slow down. We'll talk about why and what that means. Let me flip over to my screen one more time, Jim. I want to talk about market reaction to a 50 basis point cut. Now, like I said, stock markets rallying this morning on Thursday. Very optimistic sentiment right now. I'm going to overlay the S&P 500 with the Fed funds rate. So I have here now the Fed funds, the S&P 500. Take a look at the Fed funds rate overlaid. Let's just take a look at the last couple of times the Fed cut rates, not even by 50 basis points, but the last time we had a pivot. Okay, so here we have 2024. That's where we are now. This is 2020. What happened immediately after the pivot in 2019, actually? We had a pandemic. Now, granted, the Fed didn't predict this, but whatever, it happened. 2008, 2007, Lehman collapsed. The Fed actually cut in 2007 before Lehman collapsed. So a recession followed after this cut, and we had a huge crash in the markets. 2001, a huge crash in the markets. We can go back on and on. It just seems to be a pattern. What is going to be different this time?
The difference is what we talked about. Yeah. And then let's add on AI. We're earlier in a technology, I'll call it a bubble, but can just hold it right there, David. And here's the point. So if you look at the chart and if you just focus in on, let's say 2018 to 2026 on the S&P 500.
Yes.
Right. Look at what you've got. You've got a breakout from 4,800 to 3,600, right? 48, 36. You have a frame shift. That's basically what, 1,200, right? 48, 58. So, I think we overshoot. History rhymes. So where I come to this is we got to take a little bit of the 1990s, right? We take a little bit of the 1990s with the tech bubble where they got a soft landing. And then we take a little bit of the 1940s into the 1950s. But I do not think there's a lot of information about talking about a global, the 2007 era, because that was at the end of a cycle. And, 20, we had a pandemic, which was a completely and total, that was a black swan, right? So this is why I think so many people are caught off guard, because once you go back to 45 or 1920, the narrative makes so much more sense than if we use the recency bias of the last couple of times we've corrected and the Fed has cut.
Well, Jim, there's a lot of positive sentiment right now. Do you think the markets are pricing in further growth in the economy or more rate cuts, which, just in a valuation basis should help if your discounted cash flow models are pricing in a lower interest rate? What is the market pricing in today, do you think?
I think people, well, first off, it's options week, right? We have triple witching, right? Which is always a nutty week, right? I think people were very defensive. And I think the book is just basically getting balanced. I would expect, going back into history, if you really want to look at a very interesting cycle for you and your listeners or viewers, go back to the 60-year Gann cycle, right? And the 60-year Gann cycle drives the 20-year cycle, which drives the 4-year cycle. And, what the 60-year Gann cycle is telling us is that it's going to be a weird year this year. We're going to rally into the election, have a small little correction after the election, and then we're going to rally into May, March, or into the spring of next year, get a pullback, and then we have a blow off top going into the fourth quarter of next year. Those are what the cycles are saying. And so you sit there and go, well, look what's happening in the UK. We've got Rachel Reeves is the Chancellor of the Exchequer. She's a Labour a party representative. She is coming down with an austerity budget, right? And who is over there helping her or helping the Labour Party? It was Mark Carney. He's now over here in Canada helping out the Liberals. We're going into a period of austerity, right? It's going to start with G of fiscal going down, and then what's a fiscal deficit's going to go down, and then we're going to have austerity. And if that's the case, then the growth rate in the economy is there. And David, GDI, gross domestic income, already tells you that. GDI is not corroborating what GDP is saying. GDI is like 1.3% gross domestic income, which is the actual money that's created. So yeah, we're going to have a slowdown. David, we're going to go back to secular stagnation and deflation. We're going to go back to a period of time from 2011 to 2019. Take out the cloud, put in AI, put in low growth, right? Commodities and prices are coming down. China's in deflation. The global growth is going to slow. And what's going to happen is they're going to get freaked out, because my nuance in all this is that the transition mechanism is broken. David, there was a wonderful book for your viewers to get. It's called The Princes of the Yen. And it basically goes through and it analyzes what happened in Japan during their, 70 and 80s heyday. And the through line in that book that is profound, that has been corroborated by the Bank of England in 2014 in their work is, look, here's where I differ. I agree with what they're talking about. Central banks don't increase money supply. Money-centered banks do. So if the Bank of Canada cuts rates or the Fed cuts rates, but JP Morgan doesn't loosen lending standards, does it matter? And it doesn't. So let's think about the Americans, for example. Nothing has been fixed. In fact, it's worse than it was pre-COVID. We've got pre-COVID, it was pushing on a string. It was the liquidity trap. They couldn't get growth up and they couldn't get inflation up. QE didn't work to stimulate economic growth. Why? Because banks didn't lend. I'm simplifying it down a lot, right? Well, think about what's happened now. Nothing's been fixed in the regional banking crisis. The FDIC just came out the last quarter report. Bank balance sheets in the United States are worse off than they were coming out of the global financial crisis. It is not clear to me that anything's been fixed. So I think what happens, David, is we go down to 275 around the Fed funds rate, and then they're going to freak out because nothing's going to happen. And we're going to basically go into a debt deflation spiral. That is what we had and what's happening in China right now. So those are kind of the progressions I'm looking at.
Sorry, 275 in the Fed funds rate by next year? When?
I'm on the record as saying 2% by the end of next year. The Fed funds futures are already at 275 by the end of next year.
That's a lot more aggressive than the Fed dot plots, which is estimating what, 3.25 by next
Yeah,
year.
but I was at, yeah, I know. I was at I can remember being at the Brookings and Stanley Fisher was asked that question. I call him the godfather of central bankers, and he laughed at the questioner. And he goes, "So what you're telling me is that a a survey that I take in private that's not discussed about it by the FOMC is going to drive policy. The dot plots are a joke. Let's just be honest. Anybody that comes on and talks about the dot plots doesn't know what they're talking about. And if they get upset, I will throw down my trump card, which is I'm siding with Stanley Fisher, okay, who was the thesis supervisor for all these guys that got their PhDs at MIT.
I gotta push back because earlier you said the Fed is cutting rates into a soft landing, or at least they want a soft landing. That's what they want. Maybe we'll get it, maybe we won't. But why is it necessary to cut all the way down to 275 if we're getting a soft landing? It's not necessary. Just keep it high.
We don't. No, we don't. We. So when the market is, it's a guy named Newt Wicksell who came up with the theory of the neutral rate. This is their theory, right? So all I'm saying, so they're saying is that if the economy, if the mandate is if the dual mandate is balanced or achieved, then the Fed fund rate equals R star. That's their call. So, if you sit there and go, well, okay, so what's R star? Well, it's the rate of inflation plus, add whatever the real rate is for interest. The New York Fed says it's about 70 basis points. So 2 plus 70 beeps is 270 around, right? I think but let's be honest. If you look at a measurement of inflation, for example, let's use Trueflation as a measurement. Right now, I think it's about 1.2. At 70 basis points, it's 1.9. I think so. My whole point to you is, look, the rubber's going to meet the road late next year when we get to 275 and nothing happens. Rate cuts are not a magic bullet. And I'm going to refer to Mike Tyson, who basically eloquently put, everybody has a plan until they're punched in the face. The economy is going to be punched in the face late next year, this time next year. That's as they were surprised about the 50 yesterday. And all you had to do is read the beige book. All you had to do is listen to the folks pivoting, right? The real difficult question will be late 25 and into 26, where we come to the realization that nothing's been fixed.
You are making the assumption, let's go back to your deficit call. You're making the assumption the government won't stimulate on the fiscal side. You use the word austerity. This is a very unpopular word amongst politicians, by the way. They don't want to go on the campaign trail saying we're going to spend less money and be more fiscally responsible, but everyone's going to get less money. We're not talking about what they should do. Let's talk about what they will do. The CBO is projecting a wider deficit. Why could they be wrong here with this projection?
I'm not disagreeing. I think the credit markets are going to push back. All I'm saying is I'm taking the under on the growth of the fiscal deficit. I do not think that the fiscal deficit will grow greater than 25% next year. Now, for those who think that it does, I would suggest people aren't even thinking about this. Came back with when we analyzed China 2 decades ago, and we sit there and said, the level of debt has to continue to increase for growth to continue. This is about G, David. This isn't about keeping the level of GDP stable. It's about growing the level. And if you're going to grow it, and if you have the private sector contracting, then the government has to increase it by more. So all I'm saying is there's no way after an election year, given what's happening in Europe, that they're going to grow the fiscal deficit greater than 25% next year. I know it sounds profound, but just think about it. No way. Maybe it grows at 10. Maybe it grows at 8, right? But if it slows down, the growth rate slows down, what happens? And what's profound to me is, David, in the financial markets, we live in the world of the second derivative. Right? We live in that, it's always about the second derivative. And all I'm saying is on the fiscal deficit side, the second derivative is going to go negative, and nobody's prepared for that.
Are you massively bullish on bonds then? If you think the Fed funds rate is going to go to 275, will the 10-year follow? You think?
Yeah, I think it's going to be, the hardest part about this business, David, is psychology, right? So, I was asked that yesterday in New York, and what I would say to you is, look, I think it's going to take 2 to 3 quarters for people to recognize the thesis that we are talking about right now. So I think people are going to come to the assumption that it's a silver bullet or a magic bullet and everything is fixed. And I'm suggesting to you it's nothing is fixed. In fact, it's worse off. So how long does it take for the psychology to change in the market? So in other words, I think what will happen is you're going to get a steepener on the short end of the curve, right? That will happen right now. So I'm not expecting the 10-year to drop significantly from here. Okay. Pardon me. And then once people realize, oh, shoot, Jim's right, nothing's fixed, we're going back to the liquidity trap, we're going back to pushing on a string, then the long end's going to drop. So I think it's going to be a nuanced trade. First steepen, then flatten.
What do you think about this? Let me show you my screen one more time. You brought up the S word. Here's the S word, stagflation. CEO of JP Morgan warns U.S. of economic fate worse than recession. He's talking about the worst outcome is stagflation, said Diamond. And by the way, I wouldn't take it off the table. I want to get your reaction to this quote. We talked about the growth side. Let's talk about the inflation side. Why are we going to get the inflation in stagflation?
I know that's where I think everybody's wrong. Okay. Right? Markets left to their own devices are deflationary. David, we've got the second largest economy in the world in a free fall in terms of deflation and rates going down. We have excess capacity in the global economy. That is specious what Jamie Dimon has to say, right? All these people come out and sit there and say, we're in a new inflationary era. Prove it to me. Where are the facts? Right? I will give you evidence one. China overcapacity, China in deflation, markets left to their own devices. And when you get the Fed basically cutting rates and you get fiscal policy normalizing, we're going to get deflation. And that's the non-consensus view. But look at for all these people, and I'll reiterate, for all these people that say we're going back to this new inflationary era, where are the facts? Where are the facts?
Well, just to clarify, do you mean disinflation or outright deflation?
We will be, by 27, we will rue the day that the Fed screwed this up and the Bank of Canada screwed this up, right? And they are going to be forced to take interest rates below our star, and they might even have to get involved and have some type of special type. We won't call it quantitative easing. You understand? We won't call it that. We'll call it something else. But the last, Powell, I would say this. The move by the Fed after Powell 2 years ago came out and basically said, we're going to cause pain. They continued to raise rates and caused a regional bank crisis. History will come back and say that was the mistake. They had it. They lost their nerve, okay? They should have just let it play out. They got to neutral, and now they went too far, and they have to deal with the consequences. They screwed up on the way up, and they screwed up on the way down.
Well, what do you mean screwed up on the way down? I mean, forget the past. What should they be doing now?
Powell lost his nerve. In July 2022, he came out at the Q&A from the July meeting and basically said, we are there at 2.5%, right? If you look at the data, they should have just stopped there and allowed the economy to adjust. These guys and gals on the Fed and the Bank of Canada will not allow the business model and the markets to do their bidding. If they just would have stood back, everything would have been okay. But they went too far. And now they're trying to catch up. And the cement has been poured. It's over. It's over. We've crossed the Rubicon. The policy mistake has been made. 18 months for a rate cut. This 50 basis point rate cut will not be felt until the first quarter of 26. the first quarter of 26, long and variable lags. Tiff Macklin's on the record of saying that. He was interviewed by Peter Armstrong of the CBC. And Canada is more interest rate sensitive than the United States.
All right, let's talk about interest rate differentials now, since you brought up Canada and countries outside the U.S. So just today, the Bank of England met. They did not cut rates. All right, so they cut rates early in the summer. They've already done that. Why is it that we're getting a divergence of policy right now, do you think?
I honestly think that central bankers are over their skis and they don't know what they're doing. I really don't think. I mean, we can get into the reason why, but I would argue that if you would sit down and have a cup of coffee with guys like, who have a fundamental understand, I have a PhD in classical economics and micro and macro. Okay. So everything I've been talking to you about is based in theory. And then I lived my world in the private sector. I would suggest to you that the folks that are on the boards of these major institutions are over their skis and they do not understand the nuances that we're talking about. I honestly believe that.
I would assume that countries are on a race to the bottom when it comes to currencies. You would think that if the Fed cuts by 50 basis points, the other central banks would, probably adjust their policy rates to not elevate their currencies too much. But maybe I'm reading too much into this. What do you think?
Yeah, I think it's a slippery slope, because what I can tell you is that, the common thing, what we lever off of, which I think is incorrect, is interest rate differentials. Because if interest rate differentials were all we had to look at in terms of currency crosses, then, the euro would be trading at a significant discount to the US dollar, and it's trading at a premium. Right. So there's a lot of cross currents in terms of fundamentals and what's going on. So I understand what they're doing and they're going to take a pause. And I think all I can say to you is that when you look at this objectively, the longer it takes for these guys to get rates down and to breathe air into the private sector, okay, the lower they're going to have to go.
Let's take a look at my screen one more time. I want to get your outlook on the dollar now. So this is the DXY, which is the dollar, as you know, the dollar versus a basket of other currencies. This chart goes back to the 80s. I'm going to overlay this with the Fed funds rate one more time. And what do you see over the last 40 years? There has tended to be a relationship. I stay away from calling it a perfect correlation, but as you can see, the Fed funds rate has been much higher, as have bond yields, by the way, and the dollar has been much higher in the past. What's going to happen to the DXY now that the Fed, as you project, is going to go down much lower to even below 300 basis points? Is this purple line, which is the Fed funds rate, is that a leading indicator for the Fed, for the dollar?
What I would do, pardon me, can we go back? Let's, on your chart, look at 95 to 2000, right?
Okay. Yeah.
And so where I go is the silver lining for the United States, if we use the 90s as our roadmap, is the fact that the United States has AI. And if we're going to spend over the next 3 years a guesstimate of, let's say, $1 trillion in the United States, and you spread it over 3 years, that's a 1.2%, went to 1.3% boost in GDP growth. So I think the Americans have a really good shot at getting a soft landing. I don't think Europe, I don't think Japan, I don't think Canada's got that. So what I would suggest to you is, you're going to get this knee-jerk reaction. Everybody's going to freak out, and maybe the Dixie goes down to 100, maybe it goes down to 90, let's say. But then what's going to happen is AI is going to kick in as long as we keep going. And then what's going to happen is economic growth is going to be solid in the United States. It's going to skip along, and we're going to get to maybe 1%. Like it'll be a very shallow recession, or almost a recession, where I think in Europe and Canada we're going to have a significant restructuring problem. So I think in that point in time, the US dollar is going to appreciate in value because of that. People are going to recognize that AI is not a scam, that the CAPEC is real, that it's going to support that's going to support economic growth in the United States, akin to what happened in the late 90s in the United States. So I think of an initial sell-off because of the view that And then it'll start to have a strengthening period because of AI and the separation of the economic fundamentals, which I think are much more important to the value of a currency than actually interest rate differentials.
Okay, interesting. And you brought up deflation earlier. A lot of people listening to this might rejoice at the D word, deflation. We want prices at the groceries and other things to come down. But what does that imply for everything else? Do we actually want deflation? The other argument is, look, if we get deflation, people are going to lose their jobs. That's the other side of the coin. How would you respond to that?
The risk is, David, the risk is deflation. We've never know, like, let's look at Japan and look at what's going on with China. We really haven't learned how to solve deflation. We know how to solve inflation. And this is where I go back and why I've been banging pots and pans. You've got what you wanted, right? The Fed and the Bank of Canada, you got what you wanted. You got an environment where you could take your interest rates off the zero bound and get to neutral, which is 2.5 and 3. You got it. Those were shocks. Inflation was caused by shocks that were going to go away, right? So the inflation is going to come back down normally. Now you over-tightened. You've screwed this up. Now you put deflation on the table. Look, interest rates are going to go back to the zero bound. I cannot foretell the future perfectly, but David, let's be honest. Look what's going on in China. Look what's happening with Japan since the 80s. You can't say that zero bounds is off the table. You can't, because we don't know. Right. But I'm sitting there saying for the last 2 years is that the Fed and the Bank of Canada have taken grasp defeat from the jaws of victory. They've gone too far. And that points to the fact that I don't think they understand where they're doing. They're too data dependent. The data's crappy. And, they're going to rue the day that they went to 5%.
Speaking of zero bound, here's a question on cheap money asked at the FOMC. Take a listen. I want to get your reaction, please.
Edward Lawrence, Fox Business. So we've heard some speculation that you may be going with the federal funds rate to 3.5%, maybe under 4%. And there's basically an entire generation that has experienced zero or near zero federal funds rate. And some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this is a question, you mean after we get through all of this? It's just great question that we can only speculate about. Intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates. And it looked like the neutral rate might even be negative. So people were issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that. But, honestly, we're going to find out. But it feels to me and that the neutral rate is probably significantly higher than it was back then. How high is it? I just don't think we know. We only know it by its works.
One more. Yeah.
Neutral rate is higher now than it was back then. What's your response to that?
It's wrong, right? I mean, the New York Fed has a neutral. They have a model. It's actually where it is. But let's add extreme levels of debt, more debt than we did before then. That's deflationary. Let's talk about AI. You just said, deflationary. Globalization is still happening, right? China has excess capacity and we have an aging population. So somebody please tell me where the four horsemen of deflationary pressures have gone away. In fact, some of them are much stronger. But I think, I think when you listen, because that's a great clip, he doesn't know, right? And let's be honest with you, right? When I sit there and I pontificate about the substance of the FOMC and the decision making, I'm not talking about Powell. I think Powell's a private equity guy. He does things from the bottom up, or Tiff Macklin for that matter. I think these guys are really smart and they understand what's going on. If I was in that meeting, I would just sit there and go, I completely agree with you, Mr. Chairman, but my bet, and I don't know, given what I just said to you, right? Deflation, innovation, globalization, and demographics, deflationary forces are going to be stronger. So how is it that we're not going to go back to a rate where the natural rate is negative? Tell me how that's not going to, what are you hanging your hat on? Those are the four things that I'm hanging my hat on. So please counter me. Right? Don't say feelings. I'm giving you facts.
Yeah. Okay. Let's finish off on investment implications, stock market sectors that may do well during a rate cut or easing cycle. Do you have any ideas?
Yeah, I would suggest to you it's going to be so we're going to have just like the fixed income market. I think it's going to be phased, right? I think what we'll get now is everybody thinks that a Fed cut is going to be the magic bullet. So I think we get a broadening in breadth. So just buy risk, right? Pick whatever you want, right? And then what will happen as we slowly grow into this and people recognize that growth is slowing, then we're going to, in the equity market, you go to select secular growth, right? You go to secular growth. You go to low vol. You go to gold because of and you go to Bitcoin. So let me give you the numbers roughly out of my head, and I'm using the 2010 to 11 beginning to 2019. Bitcoin was the number one performing asset. Then it was the NASDAQ 100. And then pick your partner between, is it the S&P 500 or a really high quality, low vol, dividend paying ETF, right? So, so let me give you like the NASDAQ between 11 and 19 was averaging about 18%. The S&P was averaging about 14% and the low vol ETFs were about 14%. And then Canada was about 5%. It was that stark. So if we're up here, David, talking, what's the big decision for Canadians is get your money out of Canada, right? And then the other question is, I understand people don't like the volatility in Bitcoin or whatever, but depending on the vol that you have in your portfolio, right, and what you take, the history says that, Bitcoin, NASDAQ 100, S&P 500 is the way to go.
Just one remark. You said get our money out of Canada. Well, a lot of Canada's economy is tied to natural resources. Are you bearish on natural resources, energy?
I think I would suggest to you a non-consensus view that I'm working on, and it comes back to I think China is going to have to start flooding the global market with all of their inventories to finance. They need money to finance their economy, and they can't issue debt like they did after the global financial crisis. So they're going to act like Russia did in the 80s and 90s, where Russians were just flooding the global economy with inventory. So I think that is but here's the nuance with oil. I wouldn't be, we have a big buyer, which is the Americans in terms of the Strategic Petroleum Reserve, right? So do we get a buyer? At what level do they start buying, right? So I'm not calling for like a 2014 crash oil, like when Saudis, defended market share, but I could see oil trading between, like, instead of 70 to 90, maybe it's 50 to 80. You know what I mean? And I think the companies are going to be fine. I think they're going to pay their dividend. I think they're going to buy back stock and de-lever, but you're not going to get the G in it. So yes, I think for a short period of time, I think the playbook says that commodities are going to have a tough road to hoe. But that doesn't mean that the long-term structural imbalances are going away. Do you understand? It's just that if you got to hold on to them. And then the other thing, I think, for example, for your Canadian listeners, which I think is going to be very interesting, is I think within the TSX, you got to be very careful here about talking about commodities, because I think gold's in a bull market. And I think what's going to happen is gold, as opposed to Bitcoin, you're going to get a supply response in gold, right? You're going to get capital flowing into the gold space, which means it's going to be great for the gold miners. And there's a big weight of gold stocks within the TSX. So I think gold and gold stocks are going to be great. I think Bitcoin's going to be great. I think innovation is going to be great. And so I'm constructive until I really don't know. And here's the problem, David, when you look back at the history, is if we get a growth scare, like let's say late 25 into 26, then portfolios just get completely and totally delevered and everything gets sold. Do we get that? And that speaks to the 4-year presidential cycle and the midterm election pullback that we get between January and October or July, depending. It's about a coin flip of an 18% drawdown going into the midterm elections and then rallying into the end of the year. That's a strong seasonal trade that has been happening since 1920. So do we get a confluence of events so that makes, you just want to raise cash and get defensive? And hey, Dave, and think about what you asked me on the fixed income side. At that point in time, long bonds might be the place to be, right? Because, everybody goes, oh my gosh, there is a significant growth scare. The 10 years at 375, let's say, or with 350, where it is right now. And then you get that whoosh. So that's kind of what's in my mind. It's kind of our playbook as we go on this canoe trip. Of course, as we push off and paddle down the river, things are going to change, right? But, that's where we are right now.
Excellent. Jim, I always appreciate you coming on the show. Where can we find out more about your work and learn from you?
We can at Dr. J Strategy on X or Wellington-Altus. That's where we are. And thanks for having us on the show, David.
It's my pleasure. And we'll put the links down below. So make sure to check out Jim and Wellington-Altus there. Thank you very much, Jim. And thank you for watching. Don't forget to like and subscribe and follow Jim.